right. Thanks so much for joining today. I'm Steve Blumenthal from CMG. Joining me is Mike He, who heads our research here at CMG. Renee Cannison, co-founder of Evolution Credit Opportunities, and Morgan Fennell, All World Everything. How about that for a title?
Thanks.
Okay, before we get started, federal securities laws require us to make the following disclosure. Investing involves risk. Past performance is no guarantee of future results. Different types of investments involve varying degrees of risk. Therefore, it should not be assumed that future performance of any specific investment or investment strategy will be profitable, suitable for your portfolio or individual situation, or prove successful. No portion of this call shall be construed as an offer or solicitation for the purchase or sale of any security. There are additional disclosures on our website in our Form ADV available at cmgprivatewealth.com. Renee, thanks so much for joining the call. Most on the call are investors. We have a number of new clients that we're talking to. The purpose of the call today is really to walk through the strategy. If you could tell us your background, your history, a little bit about your partners, and then talk about what you do.
Sure. Thank you, Steve. So Evolution Credit Partners is an alternative credit fund. As we'll go through today, we have many specialized area in the private credit funds market that we focus on. My background is 35 years actually in high yield credit, starting on Wall Street for 20 years. Subsequently to that, I was at Harvard Management, where I was the co-head of the investment committee and ran credit, among other functions, at the Harvard Management Endowment. My partner, Mike Guarneri, is also 37 years in the business, also a 20-plus year veteran of Wall Street, with a deep dive research background. And Mike and I have really been partners in the markets for over 25 years now, working together. So certainly a long history for the two of us, and certainly a long history in the private and public high yield markets in the U.S. The fund we're looking at today, Evolution Credit Partners Trade Finance Fund, is, and Steve, you can flip if you like, is effectively a fund that focuses on short duration credit risk. Short duration, think primarily the fund is inside of 1 year as an average, with its longest maturity would be inside of 3 years. So think of anywhere from 30 days out to 3 years, with an average life of its investments well inside of 12 months. So as a short duration credit fund, it therefore has a lot of quarterly income, which we'll go through. And secondly, it has a very low correlation to the macro markets, because it's both short rate duration as well as short credit spread duration. So we find it's got a very high returning profile, with limited volatility and correlation to the larger market. We've designed the fund with two primary strategies, and that is we call the funded trades and the unfunded trades. And you'll see here on this diagram, we break out the details behind each of those trades. So on the funded trades, something which is referred to as working capital finance, that has accounts receivable financing, supply chain financing, asset-backed financing, inventory financing, things which are related to providing short-term liquidity to corporates. And the second bucket, which we'll get into a little bit, is related to other types of working capital instruments, which provide effectively off-balance sheet and hedging tools to corporations. And that is in the form of trade credit protection, letters of credit, risk participations, and things of that nature, which are off-balance sheet credit risk, or some people refer to them as synthetic credit risk. Those are the two primary buckets of the portfolio. So net, we believe that this fund, and certainly the fund has been in inception since DEES 21. Actually, its first full month was Jan 22. So we're now coming on to 3 years. We think it's stood the test of time in terms of the correlation to the broader markets has been very low. It's been a very high returning, cash flowing, no material drawdowns on a NAV basis, and it's certainly withstood the test of both sector and macro cyclical cycles. Just to give you the actual numbers, we target a 14% distribution. The last 6 quarters in a row have been just about 14% or higher. And the committed capital of the fund today is $167 million. And the fund opens quarterly right now for new investors. Steve, I'll pause there. Is there anything that you want to, any Q&A, feel free to jump in.
Thank you. No, that's great. Talk a little bit about your team.
Sure. So this is this fund, this working capital fund, is part of a larger platform. So Evolution Credit Partners, as an alternative credit asset manager, runs multiple strategies, but all with some consistency of they are the strategies are all in the credit space, they're all in the private space, and they are largely in the higher yielding credit quality. As a result of that, we have a broad team. That team operates across all our funds, and we originate across all our funds, and then allocate, of course, through an allocation policy. The approach to the market is one where we look for synergistic opportunities across 3 primary buckets. The first bucket we refer to as a capital solutions bucket. The second bucket, which is a working capital finance bucket. And the third bucket is the opportunistic. You can see from that description that the trade finance fund has the second and third buckets in it, whereas the cap solutions bucket would be in our broader fund offerings. Specifically, our flagship fund, which has all 3 buckets, is called Evolution Credit Opportunities Fund 2. We are in the process of launching Evolution Credit Opportunities Fund 3 currently, and I'll give some update on that at the end of this in terms of its target and its return profile.
Great. Should you let me know if I should advance, and I can weave in some questions as well.
Yes, that's why don't you advance?
Okay.
And good, Steve, anything?
This is what you just explained to us. Very good.
Yes. Yeah.
You know what would be helpful is give an example of the type of trade that you will put in trade credit finance fund, and then also give an example of your trade credit protection, what I call this Chapter 11 bankruptcy insurance protection, and how you think about sizing that in the portfolio, both the risks from the first allocation, and then how you're sizing the trade credit protection positions in the portfolio, not only at the portfolio level, but also at the individual risk level.
Yep. Yep. And maybe we stay on this wheel, Steve. This is a good place to answer that question, and maybe even add to that question how we originate and source, because that ultimately goes into how we risk manage and enter into transactions. So effectively, you can see from this wheel that this is effectively the menu that we offer our clients. So when we originate transactions, we actually approach a client as a specialized lender, and that enables us to be more impactful and more value added to our client base, to our borrowers. And as a result of that, we're able to attract, I would say, the best risk reward trade at any one time relative to the client base. And so to Stephen's question, of examples or transactions as you look at that wheel. We could be in conversations with a client related to their receivable financing, which is the green top of the wheel, and that effectively is where a client has sold product to one of his customers. He's waiting to receive payment, and that payment may come in 30, 60, 90 days. So what that leaves the client with is effectively a financing need until he gets paid from his client, his customer. And during that time period, he could do one of two things. One is he could try and finance that receivable. We provide that financing. The second thing the borrower may do is, instead of just financing, he might choose instead just to buy protection. And I'll get into that example now, Steve, of what could happen. So think of a client who has a receivable from a particular customer of his. He's not looking necessarily to finance that transaction, but he does want credit protection. That's effectively means he wants some kind of insurance or guarantee that assures he's going to get paid, and that the receivable, the payer of the receivable, doesn't effectively go bankrupt on him. That's the bankruptcy risk that Steve's referring to. And so we have basically looked across this wheel and provide multiple products to clients. And so we might be purchasing the receivables financing, which you see at the top of the box. But if you look further in the opportunistic solutions part of the wheel, on the right-hand side there's something called trade credit protection. We may go into the client and instead provide that trade credit protection. And I'll give some very practical examples of both, but effectively you can say we approach the client almost agnostic and look for what we think is the best risk-reward trade for us as investors. And then secondly, of course, what's going to work for the client in terms of what he's looking to do from his financing needs. And that's how we pair those two things up.
How do you
Good.
How do you compare it to others that are in your business? Banks, other funds?
Yeah.
How would you differentiate yourself?
Yeah. So we specialize effectively in providing products which are not readily available in the banking market. So as a private credit lender in general, your biggest role in the marketplace is to provide solutions which are not generically available in the commoditized market. So the largest clients in the market may be able to do an asset-backed lending facility, but as you get to other clients or have special needs, that's no longer a viable product to them. So really the role that Evolution plays is to do more bespoke one-off transactions with clients, which are related to either receivables which have characteristics that don't fit a bank, for example, concentration risk. Maybe it's the maturity or length of the receivable. Maybe it is the jurisdiction of the receivable. Maybe it is the ratings of the receivable. There's many elements of the receivable that may not be bank qualifying, and that's really where Evolution and the private markets would step in. Similar on the trade credit protection side, it's very similar to something called TCI, which stands for Trade Credit Insurance, but we're not an insurance company. And so where do we come in? We come in when insurance companies no longer provide protection. And that also has similar characteristics. Why? It could be the rating, it could be the term, it could be the jurisdiction, things of that nature, just the size of the obligor. So in all cases, really where Evolution fits in is providing the product set, which is one where the larger commoditized markets are no longer available.
Renee, are you in the trade credit insurance sleeve? Are those companies, are there clients of yours, or you go side by side with them at times?
So yeah, so the trade credit insurance and the working capital finance, and to be frank, even the cap solutions, that's a good question. We are we are something we'll call a direct lender, which means in all these cases, we're not buying things off bank balance sheets. We're not being brokered.
Right.
These are where we have direct access to the CFO and CEOs of these companies. And therefore, the credit work that we're able to do and analyze and to originate is directly with the companies themselves. And as a result of that, one is we have, I would say, a much better element in terms of our pricing power because you're doing a bilateral bespoke transaction. The second thing is you can customize the terms that fit you on a risk profile the best. And of course, lastly, you can control the analysis and the timing of a transaction, i.e. your credit research, when you have that direct relationship. So we believe that direct origination is the key, we think, element to generating alpha.
Can you give an example of something you've done recently that is a standard relationship that's been a repeat, and also give an example of something that you found really interesting and creative that you've done that will give us a feel?
Sure. Maybe I can give something that's timely and I'll say public information. Is this morning, Saks Fifth Avenue launched its $2 billion secured bond deal to finance the merging of Neiman Marcus and Saks, two well-known brands in the marketplace. That transaction was announced during the summertime. Of course, there's always risk of closure. Now that they've launched the financing and it's already, I'll call, pre-placed, that risk is diminished and will continue to diminish until the final close in the first quarter of next year. Where Evolution has an edge and comes in and has, I would say, a lot of pricing power is Evolution's been covering Saks for the last year. So in anticipation of transactions like that, I would suggest having very direct and strong dialogue with the treasurer and CFO of Hudson Bay, i.e. the parent company, which owns Saks, gives us an access and an information stream to allow us to participate in these type of transactions you see on this wheel where others cannot. So the market only sees a $2 billion bond launch today as if something special has happened. We've been doing this transaction, various credit protection and other related transactions with Saks for several years. That would be a great example of the access we have on the private side, and therefore the high returning profile we can generate well before the public markets are involved.
And what does that look like in the ballpark? You don't have to get real specific as to the return stream for the fund.
So to give you a great example, the bond price talk is 10.5% for a long dated bond. And we were doing 3 and 6 month transactions and trade credit protection. That would be something in the 18% area. So if you think about that value we've created, we're doing transactions that are 6 points higher than a term bond that's being issued. And we're taking risk that's in the 3 to 6 month area. That's tremendous value we're creating.
Renee, what percentage of your clients, at least let's talk about trade credit finance fund specifically, what percentage of those are repeat customers that either do the same deal quarter after quarter, or maybe they're working different areas of this wheel we're looking at?
Yeah. And let me dig in, Mike, on that, as well as who are the clients, right? Because
Sure.
That's a great question. Because I'm talking about the obligor, the company in which we're providing protection on. But who are these clients who are actually buying protection, and are they repeat clients? And do they buy protection on the same names every time? Which are great questions. So we have a steady client base, which is certainly increases all the time. But we have done roughly 50 different obligors in in the transaction with hundreds of suppliers. So we effectively have suppliers who come into Evolution on a proprietary system. They will make an inquiry, and we call it right protection to them, which means we provide trade credit protection to them on a bilateral basis. And so if we have $10 million of risk on a particular name across the firm, that risk might be across 15 different suppliers, maybe even 20 different suppliers. So you can see these are a lot of small trades which add up over time, as opposed to typically any one client coming in for a big lot size.
And how do you size the risks that you take? You've got a $167 million trade credit finance portfolio. How much is the maximum risk you take to a single credit? How do you think about sizing the book?
Yeah. So the risk certainly, I'll give you the generic answer, but the risk, of course, is sized by the riskiness of the particular credit. So to be frank, right? So even though we might say we are a 10% position or less firm, there are certain credits that you would never take 10% position risk because it's not the risk point that you want to be at. But we have, in the funded transactions, we have 17 positions currently across the $167 million. All positions are roughly 10% or less, with the average position size, you can imagine, therefore, is around 5.5%, 6%. So that's where we are on the funded side. On the unfunded side, the positions tend to be smaller and many more. And so, as I said earlier, we've done up to 50 different credits. We have about 35 positions in trade finance currently in the unfunded side. So a much more diverse set of risk in the unfunded side of the business because they're smaller trades.
Got it. And in the past, you've talked in terms of being there from the beginning with this fund. It's been a real learning opportunity for us, and experience, and fun to watch as it grows. In the early days, you were talking in terms of being fully ramped. So you've got the trade credit finance side, you've got the trade credit protection side. Can you talk a little bit about how invested you are in both of those buckets?
Sure.
In terms of being ramped?
Yep. Yeah. So one of the I think this is a differentiating factor for us. I do want to kind of highlight this, is that it's common in working capital oriented funds that because they're short duration, how do you keep your money invested? How do you stay invested often? And the one advantage we have at Evolution is because we run this strategy across the entire platform, we have a large sourcing engine that can ensure allocation is always efficient in this open-ended fund. And so generally, and including right now, we are generally 90 to 95% plus invested at all times. So we don't have a lot of drag at all on a cash basis in our funds, which is a huge advantage. And so that continues to be the case in the funded side of the business. In the unfunded side of the business, we typically target between 50 and 75% of capital with additional unfunded transactions. So an example would be, if you had $100 million of funded, we'd want to have between $50 and $75 million of unfunded transactions to complement that. We currently are certainly in that range. We're much closer to the higher end of that range right now. And we have been for the last 2 quarters. But I suspect that range will continue to hold between that 50 and 75% of the unfunded.
I'm going to read a question here that's come in from Paul. How scalable is this strategy given the number of companies in this space who need this service? If you had twice as much funding, would the 14% still be achievable? Great question.
Yeah, so the short answer is, I think, very scalable, and the answer would be yes. However, to ensure that that's the case, we actually do restrict how much money we take in every quarter. And for those of you who have been with us, you know we have restricted it since inception, really. We currently believe we have sufficient capacity to open it up to roughly 50 up to 50 million a quarter right now. And we're comfortable with that certainly through 2025, but we would always reassess that for the exact reason of that question, which is a great question, which is we do not want to dilute our returns. So we only take in the money when we think there's sufficient demand.
Got it. And then how does this compare to talk about Echo 3 that's coming out? Tell us a little bit about Echo 2, what you look for, and then what you're thinking is around Echo 3.
Yeah. So we have, I alluded earlier, and I guess we could stay on this wheel as well, is that this wheel represents the entire platform at Evolution. And so the upper left quadrant there, or third, which is Capital Solutions, has, unlike the other two quadrants, has longer term opportunities in them. As a result of that, they tend to be have a higher potentiality for capital appreciation, and therefore can have a higher return profile as well at times. Echo 2, for example, which is the full platform, has an inception to date of a 21% net IRR, which would put it in certainly the top decile, and to be frankly, certainly the top 5% of all credit opportunities funds in the market. And so we will be launching Echo 3 with the same strategy, same wheel. We have a stated target of 15 to 70% net. We're comfortable that we can exceed that, but we'll certainly see. But that vehicle, which is a drawdown style vehicle, which means unlike the open-ended fund, it drawdown cash as it calls cash over time as it makes investments, has a higher return profile.
3 years of funding, 3 years of distribution.
Exactly.
Kind of a 6-year-ish life.
That's correct.
Okay. And then how does it give a little bit of a feel for what a transaction in there might look like to who you're lending to?
Yep, absolutely. So it's generically the same borrower profile. That we think that's the strength of what we do, which is we take this wheel to our clients, right? And so there's a lot of synergy when you do that because you're originating through the same channels. That I'll remind everyone of that client base or that borrowing base, which is the US high yield market is 90% plus of what we do. So it's basically the below investment grade corporate, single name corporate market, largely in the US. And as a result of that, the example would be, think of a sponsored backed company that comes to market that's doing an acquisition finance and needs to borrow to complete its acquisition. It does not want to go back to its existing lender group because it has an advantage rate maybe on its existing loans, doesn't want to refinance its entire pool. If you guys look at the wheel, we might choose to provide, a mezz piece of paper or a preferred equity piece of paper related to that acquisition finance. And as a result of that, we're going to come away with a higher yielding piece of paper for the fund. In today's market, a mezzanine might be between 13 and 17%. Plus, you can get equity upside at times. You might get a strip of equity or equity warrants, penny warrants attached to it. You see the warrants there as well. So basically, you can create pieces of paper, or I should say transaction loans, I'll call it, which have a higher return profile. And then as you establish that client relationship, you might work your way around the wheel. You might then show other transactions. And so really that's the synergy, that's the repetitive nature of what we do.
A question came in asking for, and let me jump in and say, when I said ECHO 3, it stands for Evolution Credit Opportunities. This is the larger portion of the 3 billion approximate assets that you have under management are in ECHO 1, ECHO 2. ECHO 1 is pretty much returned. ECHO 2 is beginning to return investments to investors, and thus ECHO 3. So what's the minimum investment? I know we are a multifamily office with a great relationship with you. Talk a little bit about your customer base that's different from us, and what minimums are for that fund. And then we can separately talk with clients about how to gain access.
Sure, I'll give you the update on that as well. So ECHO 3, which stands for Evolution Credit Opportunities Fund 3, is targeting a $1 billion raise. We will have our first close this January, so next month, by Jan 31. Between Jan 15 and Jan 31, we will complete that first close. We'll have a second close at the end of March, and the final we'll have subsequent closes probably every quarter till the end of the year, 2025. The fund is structured as a 3-year investment period, a 3-year distribution period. Therefore, it's a 6-year commitment. And the fund is, I would say, Steve, available through feeder vehicles right now. And yeah.
Yes. Good. I got you. I can help answer that.
Yeah.
In translation, most of Evolution's customers are other foundations, endowments, sovereign wealth funds, and the commitment sizes are quite large. Another question.
Renee, can you you mentioned the IRR for ECHO 3 or ECHO 2, excuse me, call it 50% greater than the trade credit finance experience. Can you talk a little bit about the risk between the two?
Yeah, so that's a good question. The primary differential, so because 2 or 3 pieces of the wheel are the same, there's a lot of commonality in terms of the lower reduced volatility. However, the cap solutions piece does add duration risk to the fund, and therefore it has more risk related to credit spread widening. So I call it credit spread duration. It doesn't have materially more interest rate duration because most of the cap solutions bucket is floating rate, not all of it, but most of it.
Right.
So there is a little more rate duration, more spread duration in that bucket. So that does get added to the a little more price volatility in the ECHO 3 portfolio than you'll see in the trade finance book.
Thanks.
Yeah, that's a good question.
Okay. Richard is asking, how do you assess the current market demand for your products in particular and private credit in general for 2025, 2026?
Yeah, private credit continues to grow, and to be frank, not just in our focused, specialized area. Private credit as an asset class is growing tremendously. You're seeing a lot more, I'll call it migration from public market previous to the private markets. Maybe just to give you a great example, I referred early to a $2 billion secured bond being issued by SEX. That deal was underwritten by a private credit firm. So that wasn't, even though it's going to be syndicated now into the public markets, the actual backstop in owner of that was done by a private credit firm. So give you a sense of the size in which private credit has attained. So you're seeing a huge increase in the amount of private credit in the marketplace. Us specifically, we are seeing a big working capital increase. Some of that is due to higher interest rates, which, as you guys know, are now starting to persist. Because as capital's become, I'm going to use the word more normalized, now all of a sudden your efficiency related to your supply chain becomes much more important to you, right? When capital was virtually, very low costing, you don't have to be as efficient in your, they call it the days payable outstanding versus your days receivable outstanding. In other words, your sales cycle was less relevant, or I say less punitive to you. And now with higher interest rates, we're seeing a lot more focus on working capital solutions. So actually, we've seen a great increase in interest in our products.
So with the growth in the private credit space, do you see others that are coming in to compete against you? And what do you think that may or may not do to your spreads?
We've seen competitors come into some larger scale like products. To give you a great example of that is the ABL market, which stands for the asset-backed lending market. It's traditionally been a bank market. And we are definitely seeing an increasing in private participants of private lenders in that market. That doesn't compete directly with us, since that market still is a lower spread, higher rated or higher credit structured product line. For what we do, because our transactions are unique or specialized and customized for investors, we still don't find a lot of competition for us. It's really more, does our solution fit the client, than we're in competition on a term sheet basis.
So there's a lot of research that commentary coming out about concern around the growth in the private credit space. Yours is such a niche spot that you're serving. Being an expert from the credit markets and the high yield desks for all those years, and what do you have? Do you have a view? Are you worried about this expansion in private credit? And if so, what particular area is the most?
Yeah, I think private credit actually adds stability to the financial system. So let me expand upon that. Banks are at least 10 times levered, sometimes more. So effectively, moving the private credit markets and the exposure of leverage lending to the end user. And if you look at, you guys know a BDC is publicly traded, so you can see the leverage implied in a BDC, which is roughly 1-to-1. You can quickly see that you've moved risk from a 10-to-1 levered entity to a 1-to-1 levered entity. That sounds to me like a stabilizing element for the financial system. And I believe that's actually a view that's agreed to by the Fed. And if you saw the, maybe you can even circulate this, Steve, to your investors, but the Fed governor, the Fed chairman at Minnesota came out just on Bloomberg, I want to say within the last 30 days, and made a commentary. This is Kashari, said, I've looked at the private credit markets. This looks like a stabilizing element effectively for the marketplace. I would share with you that I was recently myself at the Fed in Boston, sitting with Susan Collins, and had the same discussion last week. And had this specific conversation on this.
I used Kashkari's quote in one of my On My Radar letters recently.
There you go.
Thank you for that. Okay,
Yeah.
I have another question here from Robert. Is Echo 3 a leveraged fund?
So Echo 3 is a leveraged fund. It's modestly leveraged. We target about, we call it a half a turn, which means if it raises $1 billion of equity, we would look for an ABL facility of roughly $500 million, half of the equity base. Therefore, we'd be running $1.5 billion of assets against $1 billion of equity. Or you could say that means we have 2/3 equity, 1/3 debt. So I would suggest that a 2/3 equity base, 1/3 debt is a very low levered fund.
Ed asks, what type of tax documents are provided? K1?
K1s.
K1, yes, yes. All right. Just a quick reminder, we'll finish up here in a minute. If you have questions, hit the Q&A box at the bottom of the screen. And one of my favorites, Renee, being a macro geek that I am, is what do you see in the economy? What's your read? Because you're really on the front lines.
Yeah, I reminded someone this morning. I said, the S&P is up 27% this year. So I always say, if you want to know what the economy is doing, now we continue to see the following. We continue to see, and since we cover mid-market U.S., we think we have a very good feel for the economy. We continue to see reasonable top line growth. We continue to see earnings growth as well in EBITDA. We continue to see modest default rates, although I would call them normalized now. I wouldn't call them low default rates. I call them modest normalized default rates, which for your benefit is, let's call it between 2 and 3% in the high yield market. We continue to see reasonable acquisition financing. I would have to say, Steve, the part of the market that just has not recovered is the large cap M&A. You just do not see the M&A market now going on, well over a year of a slump. Certainly, there's always the discussion that next year looks better. That's certainly the case now, but you might be a little suspect that was the case at the beginning of this year and it never materialized, right? So there continues to be a lack of large scale M&A activity in the US. That's probably the most disappointing part of the financing market. Aside from that, everything from growth, margins, default rates, recoveries of all in line to positive.
Renee, is there a particular risk environment that you prefer, that you see best opportunities?
So
recognizing, rising risk means
you
can command a higher premium. And
so we always hate to say it, Mike, but we like noise, right? I mean, that's, to be frank, that's what we like. Noisy markets cause liquidity squeezes.
Yep.
They cause certainly fear related to particular sectors, and therefore the baby gets thrown out with the bathwater sometimes. Right. Those type of scenarios, those type of gaps are great for credit opportunity funds.
Yep.
So we do believe strongly that our opportunistic set benefits from, we're a little counter-cyclical that way, right? We benefit from a down cycle a little more than maybe your typical direct lending fund would, which is doing vanilla lending. So because we're doing opportunistic credit, we tend to benefit.
Thanks.
Jerry asks, do you expect the distribution in the Evolution Trade Credit Finance Fund to maintain or even increase in the next year or so?
I think the current rate, which has been roughly that 14% net annualized per quarter, will be persistent. That is certainly our continued target. I have no reason, certainly at this time, to believe that's going to change in the near future. I think that's a pretty high return in terms of whether it will increase. I think giving our target leverage, I think it will stay persistent.
So we're of the view here of a higher interest rate environment for longer. We see inflation as a series of waves. Wave number 2 may be beginning. Wave number 1 we think has finished. We really are concerned about late stage debt cycle problems that all of us, a few of us, have experienced. Last was in the 1930s. And ultimately how it may be resolved, in our view, probably more liquidity from governments. And we think that in the end that's inflationary. So one of the things that's attracted us to private credit in general, and your fund in particular, and the Evolution Trade Credit Fund, is the short duration of the risk bet that you're making, and also the lending structure where it's SOFR, a base lending rate plus a spread. If we do see interest rates, another wave of inflation, and we see interest rates going to brace yourself, a 10-year treasury going from 4.20 to 7 or 8%, which would mean inflation's up above 10%. What might that do in terms of, certainly the spread of SOFR plus a spread is going to go up with it? Just your general thoughts.
Yeah, so there's certainly two sides to that outcome. One certainly has a positive, which is we have floating rate return profile, we certainly benefit from that perspective. But as you would know, that rate increases could lead to too high of a capital cost for lenders, borrowers, and thus you end up with a higher default rate and therefore ultimately losses. I do think that there's a little bit of a balancing act there. I think there's a breaking point, certainly for borrowers. I think what we saw in the last cycle was very survivable, if we want to use that word, as it got towards that 5.5%. But in your scenario, Steve, where things start to hit 7, 8, 9% on a base rate, that's going to be certainly detrimental ultimately, and probably cause a default cycle in the high yield market, to be frank. What's interesting though is that historically often the rate movement is often inverse to the high yield default cycle, because when companies are stumbling and the economy is stumbling, typically the Fed is cutting rates. So you typically see higher defaults with low rates, and of course, and vice versa. When rates are going up, usually that they're trying to cool an economy down, and that usually means that companies are doing well. To your point, though, the tail scenario, which would be quite unfortunate, would be companies stumbling and rates continuing to rise to control inflation, and then you have a stagflation effectively scenario, which would be quite difficult for many of the levered companies. No doubt.
As you see that, do you put your foot on the gas, take your foot off the gas?
So what we love is short duration on that reason, right?
Mm-hmm.
So that's what we love about our fund. We have a great transparency. When you maybe I can give you guys some data, right? If you looked at S&P and Moody's ratings migration, you can see right away where the ratings migration occurs over time and why the default rate looks like in a 1-year versus a 5-year scenario, whether it's cumulative or individually. And effectively, ratings migration occurs over time. So when you're in a short duration asset, you have time to react and I'd say reorganize yourself as to how you want to position your portfolio. When you're in a longer duration asset, it's difficult. It's very difficult. So we certainly like the construct of the credit ops fund because we have such a high percentage of short duration assets that we can reset ourselves and recycle that money very quickly to a higher returning profile, which would offset any of the assets that aren't resetting.
And I think I grabbed that. To be clear, for Echo 3 investors in that fund, you feel that you will still have a relative advantage in terms of speed and de-risking?
Yes.
Okay, helpful. Mike, any last questions?
I was just going to add on to that you also, not only can you recycle the capital for higher return, but also, move it to a lower risk, right? You have multiple facets of flexibility there.
Yeah, and Mike, I would even add better structures. The market's efficient, right? When spreads go wider and risk is high, the structure of the loans improve.
Right. Yep.
And vice versa. When spreads are tight and the market's hot, the structure of the loans are not as good for the lender. And so So the market's pretty efficient that way. So often there's really interesting transactions as the market widens.
Right. Thanks.
Hey, Renee, thanks a million. Really
Yeah.
enjoyed the call. Appreciate you and look forward to talking to you again soon.
Great. Thank you. Thank you, everybody.
Everybody, thanks for joining. We'll follow up with a copy of the replay and the pitch deck as well. All right, take care.
Thank you. Cheers.